Good afternoon. Welcome, Prime Minister Tsipras, to the United States. Let me introduce you to a panel of economists here to advise Greece on fiscal policy, which is inherently tied to economic growth and prosperity. I'm Professor Blood, here Professors Boffman, Gardos, and Muller.
Thank you for meeting. After 5 years of economic decline and social hardship, Greece struggles in a desperate economic situation, with problems ranging from uncertain finances to mass unemployment and poverty. Considering these difficulties, I am pleased to be in the United States, working with the most qualified economists to devise pragmatic solutions for Greece's current fiscal policy issues. My sincere hope is to plot a realistic and viable roadmap beyond the Memorandum of Understanding for Greece's future.
Thank you, Mr. Tsipras. Before we share our findings, let's look at the broader economic state of the euro area. Professor Gardos, please begin.
Thank you. Europe has experienced another volatile year. The slowdown in China, the third bailout package for Greece, geopolitical unrest, and the huge flow of refugees have all battered the region. Many European nations are facing a high fiscal risk, and we're seeing the remaking of the political order based on anti-austerity. As seen in graph number 1, GDP growth for 2015 was 1.5%. However, due to rising debt and lack of sound fiscal governance, Greece has not contributed to this growth.
The lackluster report of industrial production has contributed to this tepid GDP growth. The industrial slowdown in Germany is particularly worrisome, since Germany is the economic powerhouse of the euro. Weakness in the global economy has led to sharp declines in commodity prices and financial assets. Professor Muller, how has this affected inflation in the euro area?
The sharp drop of oil prices due to an oversupply, combined with the weakness of global demand and high unemployment, have not caused any price pressures in the euro area market. Based off the April report, the inflation is just 0% year to year, as seen on graph number 2, which is well below the ECB's target. However, businesses have benefited from this cost plunge, which has transferred savings and increased purchasing power to the consumers. Despite this, economic sentiment has declined to 103. This is still indicative of future expansion.
Unfortunately, low inflation raises the real burden of debt for many nations, and as seen in graph number 3, this is a serious issue which troubles many countries in the euro area. Professor Blood, how has the European Central Bank responded to these conditions?
The ECB's accommodative monetary policy, as per graph number 4, with its overnight rate of zero basis points, will lead to the euro's further depreciation. The quantitative easing program of 80 billion euros a month will likely continue through 2017. This should boost the euro area recovery, as businesses and consumers would benefit from easier access to credit, which would then yield better employment and an increase in exports.
But has the ECB's monetary policy supported an increase in employment?
Yes, it has. As seen in graph number 5, March of 2016 quoted a 10.3% unemployment rate, down from 11.2% 1 year ago. And further improvements have been forecast for the future given this expansionary monetary policy. However, a disparity exists between the northern and southern European regions. For instance, Germany's unemployment rate of 4.3% differs drastically from Greece's unemployment rate of 24%.
Unemployed people, especially those who have been out of work for extended periods of time, constitute major concerns. Forgotten job skills, draining confidence, lower birth rates, and the overall increase of poor health are notable, especially in areas with high unemployment.
The region needs a period of above potential growth to bring down unemployment and reduce debt. The ongoing refugee influx could offer some economic growth in the northern regions, where there's a stronger demand for labor. If governments can ensure migrant successful integration, labor markets can better align with industry demands.
A continual hindrance to growth within the euro area has been the lack of sound fiscal policy. The Stability and Growth Pact did not secure fiscal effectiveness. In fact, it has limited the overall fiscal flexibility of euro area nations and challenged national sovereignty in some regions.
Public finances are expected to face significant pressures as a result of demographic trends, including aging populations. Among euro area member states, healthy public finances and sound fiscal policies are essential for growth. While each member state must have appropriate fiscal policy, it is important that the overall direction of fiscal policy is suitable for the entire euro area. Greece, having diverged from the Stability and Growth Pact, has experienced numerous fiscal problems.
Greece has a national debt of 316 billion euros. As you can see on graph number 6, debt is currently 179% of GDP and is expected to reach 185% in the next 2 to 3 years. This is now expected to be paid down for at least another 4 decades. As far back as 2001, when Greece became the 12th member of the euro area, there are concerns about accepting economically weaker nations into the bloc. However, the Greek government still hailed its membership as an accomplishment. Unfortunately, it became clear that the Greeks now really met the fiscal conditions for membership.
Greece hiked taxes but proposed little to no reforms. And by 2010, Greece lost control of their fiscal policy as interest rates soared. Their only recourse was to turn to the European Commission, the International Monetary Fund, and the ECB for help. Greece was forced to accept a harsh austerity package requiring deep budget cuts and steep tax increases, even though this is counterintuitive for a country in recession.
Greece is currently enduring unsustainable economic conditions with bleak prospects for future growth, as we sink further into an austerity-induced depression. Please note slide number 7. Note how year-to-year GDP shrank by 1.2%, and how there is no growth in sight before 2017. The Consumer Price Index fell 0.7% year-to-year, and Greece has been in deflation for the past 36 months. The unemployment rate still stands high, with youth unemployment at nearly 50%, and with no plans of educating or training for the future generation.
The lack of sound fiscal policy has led to a myriad of issues for Greece. To offer reforms, we must review these issues. Prime Minister Tsipras, would you like to begin?
Greece is suffering a human and capital outflow crisis. Approximately 200,000 people, or 10% of the university-educated population, has left the country. Many of them believe my country has no available professional opportunities, robbing us of the brain power needed to generate productivity in a growing economy. As you can see on slide number 8, the money, which is circulated to other destinations in the euro area and overseas, has deprived Greece of over 20 billion euros in revenue.
These financial assets have not been taxed. Historically, Greece has struggled with tax evasion, concentrated notably within the highly educated and wealthier citizens. As seen in slide number 9, Greece maintains the EU's highest self-employment rate, with over 1 in 3 Greeks working for themselves. The government is not collecting at least 28 billion euros every year.
Tax evasion is not the only revenue issue. Greece's diminished coffers are largely the result of its growing shadow economy, which amounts to around 25% of Greece's GDP. Had it been subject to taxes at the prevailing 40% rate, Greece's shadow economy would have contributed 22 billion euros in revenue, greatly reducing the need for international bailouts.
In part, a shadow economy exists because doing business in Greece remains extremely difficult as compared to other nations. Note slide 10. Everything from starting a business to dealing with construction permits and even getting electricity remains an issue in Greece.
Additionally, urgent taxes demanded by the austerity programs of the Troika are burdening businesses. Should fiscal reforms occur, they would help to promote growth in the medium and long term, in addition to helping the country increase income via investment and exports. This would potentially facilitate debt repayment.
However, despite recent funding, debt repayment is becoming even more difficult, with the 50,000 Middle Eastern migrants currently stranded in Greece. Our government is cash-strapped and cannot give these people proper asylum.
All of these issues are serious, but most importantly, Greece faces a demographic challenge. See graph number 11. Currently, 20.2% of Greeks are above the age of 65, and in the year 2050, that number is expected to rise to 40.8%. This is significant since Greece's pension system costs 28.5 billion euros annually, and lenders want cutbacks of approximately 1% of GDP this year.
To pay pensions in 2016, the Social Security Fund, apart from contributions and state funding, will need to find additional funds of over 980 million euros. Pensions, the primary source of income for roughly half of Greek families, has been cut as much as 40%. Without pension reform, Athens cannot conclude the first review of its compliance to terms of a bailout.
I desperately need your help to confront the Troika and create economic stability and growth through fiscal reform. I want to maintain a social safety net that coexists with a viable policy to promote growth. We cannot continue to cut spending in our economic state. Instead, revenues and spending must be shifted to support growth and a greater fiscal multiplier.
We cannot realistically address all of these issues. These are the 3 areas where fiscal policy can especially create an environment for better growth: employment, productivity, and investment.
Let us first look at employment. Greeks are entrepreneurial. We need to eliminate the red tape that has suffocated the private sector. Local Greek company, Stomatio Plastics, recently lost a bank loan due to bureaucratic inefficiencies. Simplifying procedures through greater e-government spending will promote productivity in both the government and the private sector.
The government needs to incentivize young people with tax breaks to start new businesses in promising areas such as e-commerce, green technologies, and software development. This will promote growth.
But growth cannot happen without an educated workforce. Unemployed youth need better vocational training to support new enterprises. While there is an upfront investment for apprenticeships and internships, a skilled and educated labor force will create a productive environment, with rewards consistently multiplying.
Greece also needs to reduce more regulatory barriers to competition. In 2013, a law was passed to promote competition in key sectors such as tourism and retail trade. Many regulated professions have also been opened up to more talented people. Some estimate that freeing up all the closed professions in Greece could boost GDP by up to 17%.
Additionally, we need to increase the labor force participation rate by lowering taxes. This will make it more attractive to be in the labor force rather than out of it. Greece currently has the highest tax wage in the OECD for an average married worker with 2 children at 43.4%, while the average is just 26.9%. Productivity could be enhanced by lowering corporate taxes to promote investment and encourage companies to stay in Greece and hire more people.
Workers should be given an incentive to retire later and contribute to their retirement longer. Those eligible for a pension at 65 after 40 years of service by 2022 should receive only 80% of their pension. But if they can continue working to the age of 67, they should receive 100%.
Greece can further modernize its economy through privatization. This will reduce public debt and increase productivity. Although 3.5 billion euros have been raised to meet IMF guidelines, Greece needs to sell more assets.
The pressure to pay down Greece's debt is intolerable. My government will continue to oppose privatization in order to maintain the dignity of the Greek people. These are not legitimate sales. They're fire sales, now owned by foreigners. As a proud, sovereign nation, having both our fiscal policy and assets controlled by foreigners is simply disgraceful. What, am I supposed to sell the Parthenon?
Well, Greece needs to show more fiscal responsibility and streamline their departments. The Greek government has to be an example of efficiency. Currently, 1 in 11 Greeks are employed by the government, which is far too high. Despite a simplified tax system initiated in 2014, tax evasion remains an issue because the tax burden is still unfairly distributed.
Greece first needs to work on collecting its taxes. We've spoken to the head of the IRS, Mr. John Koskinen, who has volunteered to advise Greece. No meaningful reforms can be made until Greece mitigates its tax evasion and shadow economy.
Greece can either use the carrot or the stick to deal with the shadow economy. I support the carrot with a subsidy of 2% of sales from businesses, while individual citizens will receive tax breaks of 5% if they are honest.
I support the stick. Greece should increase fines to a strengthened tax agency. Corporations and people will pay a penalty of 15% of what they owe, plus accumulated interest and even potential jail time.
Although we disagree, can we now get to the most serious challenge for Greece?
Overhauling the pension system remains Greece's greatest hurdle. I have been elected on an anti-austerity platform. I want to reduce the required pension cuts by increasing worker and employer contributions to the Social Security Fund.
I support your idea, although the IMF claims this will only make it more unlikely for employers to hire because workers will become more costly. But the OECD wants you to consolidate the pension system with disincentives for early retirement while increasing health contributions for pensioners.
The current pension system is unsustainable. There aren't enough future employees to pay the needed funds. A jobless rate over 20% for more than 4 years has created an underclass of people who have never contributed and will never qualify. Currently, within Greece, there are more people reliant upon pensions and unemployment insurance than there are in the labor force.
Many households are dependent on pension incomes of single family members to survive. Employers, to avoid pension obligations, fail to register employees so they pay off the books. My government isn't willing to cut payments to pensioners. The fears of political instability and public unrest are simply too great. Both farmers and professionals together are rioting and blocking the roads.
However, cuts in the pension system could lead to long-term benefits. If Greece shifts future spending away from pensions, it could use these extra funds for investment, education, and infrastructure.
The Greek economy is in shambles, with economic conditions and hardship not seen since the Great Depression of the United States. There is more than enough blame to go around. The austerity programs have been too austere.
What do we do now before the Greek economy collapses? Our recommendations are that the Troika must allow Greece some breathing room and relax the austerity measures that are strangling its economy. There must be more loans, not simply to pay back debts, but to foster human and fixed capital. In exchange, the Greeks must thoroughly embrace our fiscal reforms, eliminate stifling regulations, collect taxes, and reform pensions. By taking these steps, you can spark economic growth in both Greece and the entire euro area.
Thank you for meeting. I will bring these ideas back home to my people.
Okay, thank you very much. Can you hear me? Yeah. First question. The European Central Bank recently made its interest rates negative. Why did the central bank do this?
So the hope for the negative interest rates on behalf of the ECB is two things. First off, they want to make sure that the banks are more apt to give out loans. By having negative interest rates, they have to pay on keeping their excess reserves. This means that they're more likely to give out loans. Additionally, it works the same way for people. People that keep their money in the banks have to pay to keep their money there. By having negative interest rates, they're more apt to take out the money and spend it in the economy, thus stimulating growth.
However, there are some dangers. For instance, if we see an economy with low confidence, then there's a danger that there will be a system of reluctant borrowers and reluctant lenders. And if this happens, then the negative interest rates will not have much effect. There's also another danger that if people do take out these loans from the negative interest rates from these banks, then there's a fear that these people will either store it under their mattress, if you will, or leave the country. Ultimately, it's important that monetary policy is not the only thing that's driving growth. This monetary policy, these negative interest rates, they have to be complemented by fiscal policy reforms so they can really take effect.
So this is a little bit of a broader question. Are the current fiscal policies of the euro area governments and the monetary policy of the European Central Bank reinforcing one another? Why or why not?
Well, currently, you're correct. There are separate fiscal policies and monetary policies within the euro area. There is a unified monetary policy, but the fiscal policies of each individual member state are on a member state basis. And because of this, the monetary policy ran through the ECB, they're the center bank. They try and do what's best for the bloc as a whole. And this could potentially be problematic for these individual fiscal policies because it kind of forces them to comply with the ideals of the monetary policy. Whereas if there were to be these nations, if these nations were to have their own monetary policies, they might perform different policies in order to have it support their fiscal policy.
So let's look how monetary and fiscal policy are affecting each other in a country like Greece. Currently, Greece is affected by the monetary policy of the ECB, which has zero or negative interest rates right now. But Greece is not making necessary reforms to their system that this would go a long way. So in a country like Greece, they have not made fiscal policy reforms to make it easier to start a business. They're not making fiscal policy reforms to make it easier for people to get employed. And if they're not making fiscal policy reforms here, it's harder for people to get these loans and actually start businesses that will lead to growth. So currently in Greece, we're seeing that monetary and fiscal policy are not working together because fiscal policy is not making it easier to start businesses.
However, there are some aspects of monetary policy that are trying to help Greece in its aspect to promote growth. So the ECB has recently launched programs of quantitative easing and negative interest rates, which are intending to lower long-term interest rates and make it easier for people to take out loans. As my colleagues mentioned, there is still some barriers to people starting up businesses in Greece, and we still have a system of reluctant lenders and reluctant borrowers. But for the most part, the ECB is doing everything that they can with these monetary policy tools to try to promote growth in Greece.
You mentioned that the refugee influx might serve to boost demand in some of the countries that are prepared to accept them. Tell us how that works.
So there are currently 50,000 refugees who are stranded in Greece, as we mentioned in our speech. And these people, they still have needs, and they are still going to be spending within the economy if they are assimilated into the Greek economy. So if the Greek government can efficiently invest in programs like education or other assimilation programs to help these refugees assimilate, and not just Greece, if countries across the entire euro area can help to assimilate these refugees, they will support another population influx that will be buying in the country and that will help demand to grow.
Not only that, but Greece is well known for its tax evasion. So what these new immigrants or these new migrants who come in will be able to really change the culture of Greece by helping it not only through supplying new jobs, but also by helping by paying their taxes and following the rules and avoiding this tax evasion, which will give more money to the government as a whole, and be able to help the economy.
Not only that, but although the refugees do help economically, they also help socially. First and foremost, they value an education in the euro area. So they're going to be productive citizens, and if they are assimilated, pay into these pension programs and entitlements. However, most of these refugees are younger people. What this will help to do is counteract the larger and increasing elderly population in these areas. As a result of this, you can help ease the demographic challenge like we mentioned in the speech.
Now, all of this is easier said than done. Of course, unfortunately, many of these refugees currently have not yet assimilated into to this European culture. And Greece, unfortunately, is faced with the task of receiving a lot of these refugees. And this isn't because of their economic state, it's because of their geographical location. And because of this, all these refugees, this huge influx would be happening regardless of Greece's economy. And this is why that this crisis, this problem, should be treated as an independent crisis, which not only Greece, not only the euro area, but the entire world should work together to solve.
One of the things that you mentioned was confronting the troika with some of the new requests to figure out new terms. As you know, these terms were already discussed last year. When would be your next opportunity to bring this up with the troika? Is there a deadline?
So, yes, there is a deadline because the talks about Greece's first review of its third bailout have been dragging on since November. And these talks are going to have to come to an end because Greece desperately needs the bailout money. It is trying to get this 86 billion euro bailout in order for Greece to pay back the loans that have matured that are due in July. And Greece owes 3.5 billion euros in these loans. So if it does not have the money from the bailout, it won't be able to pay back these loans. So yes, if Greece is going to start confronting the troika, it has to be soon in order to get this bailout money. Additionally, the people in Greece have been very unhappy with the austerity measures that are going on. Both private sector and public sector employees have been rioting in the streets because there have been 11 pension cuts in the past 5 years, leading to a reduction of 40%. This social cost cannot be sustained by the Greek people much longer. Prime Minister Tsipras only has a 2-seat majority in parliament right now, and if the political instability were to increase further, there is the possibility that the prime minister could possibly be overthrown. This would be a very bad thing for the Greeks because it means that the new party who stepped to power would have to resume negotiations with the troika but backtrack several months.
Partially what's making the negotiations so difficult with the Troika is that the Troika has different ideas in mind depending on their branch. We mainly see a difference between the goals of the IMF and the European governments. So the IMF has a goal of having Greece make many reforms over the long period of time, while we see the Germans in particular and the Europeans want to make sure that Greece remains in an austerity package and having an austerity economy. We also see that the IMF is pushing for a debt haircut, unlike the Germans who are very against this. We also saw recently in a leaked IMF call from WikiLeaks that they're planning to push Greece towards the brink of disaster before they come in and save them. This is what's partially making relations so tense between the Greeks and the Germans and the IMF right now.
Okay, so following on, you said that Greece would have to pay back its debt within the next 4 decades. How do you come to that, and what would it really mean to pay back debt, in your view?
Sure. So currently the way that Greece's debt is structured is over a period of 4 decades. This is to make sure that Greece doesn't have too much of an economic impact by paying back loans in too short of a time. So if we saw Greece try to pay back this debt in, say, 10 years, they would have to make such massive cuts to their economy that their GDP would sink. There'd be little to no investment in education, infrastructure, research and development. And what this does, it's detrimental to long-term growth prospects of Greece. So they chose to spread it out over a period of 4 decades so they could slowly pay back this debt while creating reforms for long-term growth.
Just to build off of what Professor Blood is saying, many of these reforms are almost forcing the Greeks to change their culture. A great example of this are the pension reforms and the pension cuts. So by extending the period of time, what we're trying to do is we're trying to make sure that the Greeks are both transparent and they're guiding the people where they're going to go, showing them by making these pension cuts, infrastructure, education. What we're going to do is move the Greeks in the right direction through increasing transparency and increasing growth.
So just to elaborate on what my colleague was saying, the pension reforms are going to take time because the Greeks, you can't simply cut pensions on the workforce that is already working right now because the people are simply not going to take those pension cuts. So you have to kind of stretch it out over a longer period of time so the people really have time to adjust to this new way of life in this new really economic standpoint. And another reason why Greece's debt maturity is so long is because their German creditors are not going to accept a debt write-down. They want Greece to pay the full value of the debt back, meaning that Germany is willing to extend maturities as long as it takes until Greece is able to pay that debt fully back.
Now, ultimately, a balance needs to be achieved between paying debt and initiating reforms. It is not good for the Greek government at this point to spend too much emphasis, to put too much work towards paying either one or the other. It's really important that a balance is achieved between repaying this debt and initiating the necessary reforms.
Thank you very much. Time's up.